Could it be 1929 all over again? A single chart predicting our market is set to mimic the crash that most of us know about in our nation's history, Black Tuesday. It's been making its way around financial circles, but should you, all small investors, even take notice? We're covering your assets tonight with Sean Hyman, trader and editor of Money News Ultimate Wealth Report, Frank Fantozzi, president and chief investment officer at Planned Financial Services, and Gene Erkin, managing director at the Capello Group. I want to show this chart so people can see what we're talking about. Essentially, it compares the Dow way back then, 1929, with what's going on in the markets right now, and it's following the Dow Industrial here. Sean, to you, what do you make of this chart? Is it telling us anything we need to know?
Well, to me, that chart doesn't scare me. I mean, I am a chartist and a fundamentalist, but you can lay a lot of things over each other and get them to look like something. But you know, the stocks that were in that index then and the stocks that are in the index now are very different. The economies are very different from what they were then and now. They were very industrial back then. They're very service-oriented now. So there's a lot of differences, and so it's really not apples to apples type of thing.
Do you think that we
so
could be in for a big crash?
Yeah, I do think we could be in for a big correction, not because of that chart, but because, you know, the valuations of stocks are now towards the high end of what they historically will do, and also the charts are very extended away from major moving averages, as much as the crash that we had in 2007, and even more so extended than what we had in, what we had in 2000, and more than what we had in 2007. So in other words, we are in the danger zone. Stocks are too high, but not necessarily because of the 1929 chart.
All right, I got you. Frank, what do you say? A lot of people really worried about this chart. A lot of individual investors out there looking at it thinking, what do you make of it?
Well, I think it's nice to go down memory lane, but I don't think it really has a lot of relevance today. I mean, there's three major differences between 1929 and today, and one of them is that the regulatory environment is totally different to protect, you know, the consumer. Obviously, there's been a lot of acts that have passed since that time. We're in an interdependent world economy, and access to information is much more ready. So I don't really think it has a lot of bearing on what's going to happen in 2014.
You know, we also made the same chart looking at the S&P 500, not just the Dow stocks. It looks very different from that, from the one that was scaring everybody this weekend. Gene, how do you make sense of these two different ideas here?
Well, from an investment banking perspective, we're always interested in the duration of a bull market, as many of our clients' businesses do not trade like a stock. As a result, we're always actively addressing and considering the risk of a downturn. Now, that being said, bull markets do not die of old age. They die when an outside shock triggers the next bear market. I don't see any market risk here, nor do I see any of the typical triggers that have ended past bull markets.
But Sean, it is a little long in the tooth, my friend. What are we at, 5 years now? Or we're, you know, this bull market is getting a little gray. It's getting a little saggy. What do you say?
It is, and the problem is there gets to be an investor comfort area that happens. I was talking to one of my friends the other night, and he was very comfortable with his stock portfolio because of what the last couple of years have done. But what the last couple of years have done has nothing to do with what the next couple of years will do. And so there's really not as really a good of correlation there as a lot of people think. So emotionally it may feel good, but doesn't have anything to do with what the fact is.
So Frank, what are you looking at right now as the thing that's driving the markets? What should we be following if not these charts?
Well, there's three things I would tell investors to focus in on: consumer spending, business spending, and earnings. I think, you know, we moved from a policy-driven market in 2013 to really looking at fundamentals in 2014. If I focus on those three, I still think the S&P is going to turn in around 10% for 2014.
Are you confident about consumer spending?
Well, of the three, that's the one that's probably lagging a little bit, but I think that's going to pick up as the year goes on.
Interesting. Gene, to you, what do you see as the thing that's most important to the market right now? People like to look at fundamentals. Is that the thing to look at?
I certainly think it's something to look at. I think valuations are getting a bit high, but I think it's just overall market confidence. You know, the market confidence is there. The IPO markets are strong. Volatility is low, and I think that's going to, you know, bode well for a strong equity markets into the future.
Sean, everybody talks about it being a stock picker market this year. Do you agree?
I think it is because, I mean, right now most sectors are so elevated that you really do have to pick out those areas of the economy that have been overlooked. And right now it's like commodity stocks, it's commodity ETFs, it's old high-tech, things like Cisco Systems, Intel, things of that sort.
Frank, what sectors do you like?
Well, we're definitely in favor of the energy sector, especially on the construction side. You're going to see transportation and infrastructure being a real big play this year, especially with the whole shale gas development.
Gene, is that overplayed? Is that done? Or what sectors do you like?
From a deal perspective, we're seeing a lot of activity on the energy side, healthcare, tech, and consumer retail.
All right. Well, guys, thanks for coming on tonight. Interesting conversation. We'll try not to take those stock charts too seriously. Thanks so much.
Thanks for having me.
Thank you.